Good morning. I'm Diane Whalen, and this is Linda Chapman, and we are embezzlement survivors. Tell you a little bit about me first. I am the elected mayor of the city of Florence, first elected in 1999. My finance director had been in his office for 11 years at that time. I had just gone through a campaign for my first re-election. It was the city I grew up in, the city that I watched grow up, and I survived that election, proving that I was more than a one-termer, elected on the name of my father. My father was the mayor of Florence from 1961 until 1981, and there was a lot of talk in the beginning that I had only been elected because I had the name Ewing in my name. So the second term came up, and I won that race, and I was feeling pretty good about things and getting ready to do a lot of good things for our community and continue to see it grow. The city was doing well. We were growing. We were attracting businesses. We were successful. We were financially stable. And our auditors were just wrapping up their annual audit. So everything seemed good. But you know that feeling you get when you start to doze off and something jerks you awake? You feel like you're falling and you catch yourself. That's kind of the feeling that we had when we sat down for a late evening meeting with the members of the auditing firm who had been doing the city audit for nearly 40 years. In the course of a regular audit, they happened to come across a questionable transaction. That transaction led to a bank account that, while it had a city name attached to it, capital improvement account, it wasn't a city account at all. It was an account that our finance director, who at that point had been in office for 15 years, had placed the money that he thought he was entitled to. So we spent the next week, he was on vacation, luckily for us, but we spent the next week going through things and pulling together the proof so that we were able to file charges against this trusted employee. And it was a week where we spent questioning everything, everybody, every transaction. Kind of a surreal week of not really believing you were going to find what you found and being amazed as it unfolded in front of you. On Monday morning, we had the Kentucky State Police, the Commonwealth Attorney, the City of Florence detectives, and the FBI in our office. As Mr. Epling sat down to meet with the auditors, and they started asking questions. When he got up to leave the room to get them some information, he was taken into custody and carted off to jail. At that point, and from my perspective, I felt like it was very important that we had to be in front of it. If you take a 15-year employee to jail in Boone County, somebody at the jail is going to call the press. So we wanted to make sure the press knew what was going on, and we were prepared to tell them everything that we could possibly tell them. We called a press conference, contacted a PR firm the week before, and we decided that we would have the media all show up. We had all the local television stations, the newspaper there, assured them that we were as angry and disgusted and surprised as anybody, and that we were going to do everything in our power to make sure that justice was done. That meeting began a year-long adventure, and it was an adventure from hell. We uncovered lies, theft, arrogance, strippers, adultery, a pending divorce, and a lot of other things, including a nudist colony that he belonged to. Made-for-TV movie kind of stuff. This is what this was. Ron was initially placed on administrative leave without pay when he was arrested. But the newspaper headline that you see on the clipping here appeared on Christmas Day that year. And he had already admitted to the police that he had opened this dummy account, and it was for the sole purpose of embezzling money from the city of Florence. When he was taken into custody, he told them that he knew it was more than $1 million, but he didn't think it was $2 million. We were all very violated feeling. The elected officials, the employees who knew him and worked with him and trusted him, the general public. The reaction was loud and angry and sometimes hateful. The anonymous emails, the people who said we should have known, the people who said, how could you not miss this money? We stayed in front of that as best we could. We were as proactive as we could be. We called press conferences when we had information to share, and we answered any question that we possibly could. And then came the kicker. As we followed the trail, the amount began to grow. A 15-year scheme by a trusted employee was systematic and detailed, and the total came to close to $5 million. The anger grew along with that amount, and the public disgust grew louder, and the newspapers and the editorials, and then he surprised everybody and pled guilty to 35 counts. We were all prepared to go to trial. We were sitting there and waiting for a trial date, and he put in this guilty plea and wanted to take responsibility for his actions. He took the trust of the people he worked with. He took the public's trust. He robbed us all of a lot more than just monetary assets. After he pled guilty, he was sentenced to 16 years in prison. The judge said his hands were tied, with the maximum sentence being 20 years, despite the level of the offense. And the state of Kentucky, Mr. Appling would have been eligible for parole in 3 short years. The punishment didn't seem to fit the crime, and the public officials we felt needed to be held to a higher standard. So on January the 22nd of 2003, we requested that a new law that very specifically dealt with violation of public trust and increased the penalties for officials who intentionally take public money or property. The Appling Law, as it came to be known, passed the Kentucky State Legislature during the 2003 session.
Headlines on the next slide is City recovers over $4 million. As the mayor just said, the embezzlement reached almost $5 million. It's pretty remarkable that the city got back almost $4.2 million. How did the city do this? After Ron was arrested, all of his assets were frozen. Luckily for Ron, he kept most of his bank statements, some of his canceled checks, his check registers, and a briefcase in his city office. He actually invested some of the funds very wisely in business ventures and a couple parcels of real estate. He had several retirement accounts, and he had a $500,000 life insurance policy that the city could prove the annual payments were paid for by embezzled funds. And you're probably saying, why does that matter? The date on this article is July 15th of 2004. Ron Appling passed away in October of 2003. So while the recovery effort was going on, Ron passed away, we discovered the life insurance policy, and we were able to use those funds as leverage to get additional funds recouped. Recovery of funds, $4.2 million. There was 2 different sources, third parties and personal assets. A little over $1 million was recouped from the surety bonds and the crime provision policies that the city had. From the bank accounts, from the bank and the account, $775,000. From personal assets, we recouped $789,000 from Ron's business ventures, $767,000 from the 2 parcels of real estate, $591,000 from cash and pension plans, and estimated tax payments in the amount of $160,000. You're probably questioning why estimated tax payments. Ron was so afraid of the IRS that when he filed his annual tax return, he actually had a Schedule C for a business entity called Capital Improvement Fund. So the embezzled funds that he was taking, he was reporting those as income via his tax return and making estimated payments both federal and state. Ron was arrested in December of 2002, so the city was able to recoup the federal and state estimated tax payments that were put in for that calendar year tax return. And then we also recouped $17,000 for forfeited vacation pay that was still on the books when Ron was arrested. Then the headlines came. Appling usurped duties of the mail clerk. Accounts say allowing his practices inviting trouble. The article goes on to state that Ron had this scheme that was elaborate, and he was able to go to the mailroom and get checks. That wasn't an elaborate scheme. That was simply a breach of internal controls. The next headline came. Access to mail may have led to fraud. How Appling fleeced Florence. And we have the flow charts of how everybody figured out how he did it. And we even have Ron from jail offering his advice, telling everybody how he did it. Come talk to me, I'll explain to you, and I'll let you know how you can prevent this investment from happening. So a little bit of history of when and why. Ron was hired in 1987 as the city's first finance director. He was promised a staff of 3. He was promised a salary increase the next year. The next year came and went, no salary increase, no staff of 3. So Ron decided he was going to go ahead and create his own salary. And he started to take money, and he justified and rationalized that it was okay because I was told I was going to get a salary increase, and here I am doing the work of 3 people, so it's justified. How? Ron actually changed methods based on changes in the accounting software. Ron originally started taking checks and stashing them in his desk drawer, and he would wait for a CD to mature. And when the CD matured, he would take those checks out of his desk drawer. He would deposit those into the city's general fund as if the CD had been redeemed. The CD that was actually redeemed, the proceeds of those actually went into his personal capital improvement account. After that, the city changed accounting software. Ron was about 6 months into the software, and he started noticing that there was fallacies in the system. The major fallacy was that the modules were not interfacing with the general ledger. So Ron kind of was thinking about that for a while. And yes, I did talk to Ron when he was in jail, so I have this first-hand knowledge. He said one day, one of our employees from the city of the golf course came down and handed him a $50,000 check. It was a repayment for a receivable that was outstanding. So Ron took the check and he thought about it for a while. He thought about the new accounting system and how the cash receipts module doesn't interface into the general ledger anymore. It was like, he had his aha moment, he said. I don't have to wait till the CD matures anymore. I can just take the check, manipulate the cash receipt patches as they come over, post those into the system. The city was growing from 1985 into 2000 by leaps and bounds. The revenue accounts were increasing every year. Nobody noticed that he was deflating the revenues and posting the checks to where they should have gone and actually taking the money. Ron did have access to the mail. He did make the daily deposit. The city never utilized an endorsement stamp for deposit only on the checks. And in total reality, there was just a total lack of segregation of duties within the department. The rebuilding process. How do you start? When you come in and you find an embezzlement, how do you start tearing this thing apart? You do it bit by bit, and you start from the bottom and work your way up. First thing the city did was put immediate controls in place in the areas where the fraud had occurred. No more access to the checks, no access to the mail rooms, got out a signature stamp, every check was logged, it's stamped for a deposit only. And you have to regain the stability and the status quo of the department. When you go through an embezzlement, the employees, their emotions are running high. They get nervous, they don't know what's going to happen next. So you have to be able to come in there, remind them that they have a job to do, they still have the same job to do today that they had last week, and get them refocused on doing their day-to-day activities. The city started a search for a process for the new finance director. It's key after that happens to get somebody in place that can run the ship, regain control, and head it in the right direction and start tearing it apart. The city determined the scope of the fraud. They actually restated the financial statements as of June 30, 2002 and 2003. That included fair representation of the financial statements. Right on the face of the financial statement, the loss due to embezzlement was disclosed. In the footnotes, there was footnotes detailing the embezzlement and how much was taken. The GFOA has an annual program, it's called the CAFR Award. And basically what the CAFR Award does is basically instill public trust that your financial reporting meets certain accounting standards. The city had never participated in this program before 2003. So we restated the financial statements. We decided to go for the CAFR Award. We had embezzlement marked all over the place. Lo and behold, the city obtained its first CAFR Award. Subsequent year financial statements disclosed the recovery of the money from the civil lawsuits that I just previously talked about. We revisited the structure of the department. We looked at all the job duties of all the individuals, and we looked at all the personnel. We made the tough decisions about changes that were needed in the area of personnel. When the new finance director came in, it was pretty obvious after the first few weeks that most of the employees and the staff in the finance department had very little bookkeeping knowledge. And I later found out that we had a lot of good qualified candidates that came in and applied for jobs. but they were passed over because they were handpicked by Ron, obviously for a specific reason. So we made the tough decision, we made the personnel changes that were necessary to bolster the finance department and regain the structure that we needed. The front end, every employee was cross-trained for every duty that happens in the front end. Nobody had specific function or sole control over any specific details or functions from that point forward. We revamped the entire department systems. The accounting packages, obviously, we knew there were fallacies in those. We had antiquated real estate tax software. We didn't have any fixed asset software. So we basically tore everything apart and solicited new new accounting packages. Part of the accounting package was getting that in, having a system that has built-in security, having a system that has audit trail functionality, having a system that has workflows that you can design to prevent access from people that you don't want access to have. We developed controls around each one of the modules in the current software. We developed manuals that every process that happens in that software is documented so that anybody in the office can pick that up and should be able to run with it. Everything is fully documented, and with every software upgrade we do, we continually update that manual. You have to continually monitor all the assets within the department and those that have financial implications in the other departments. You have to continually review the appropriateness of your surety bond and crime provision coverage. And you have to understand what an audit is. When an auditor comes and presents you the engagement letter, most people will take that engagement letter, they'll look at what the price is, and they'll sign it. Every standard engagement letter follows a specific format laid out by accounting principles and policies. You have to understand that an audit is not designed to detect fraud. It's simply a test of transactions throughout the year, and it does not provide any insurance on internal controls. The management of the entity is responsible for establishing and maintaining effective internal controls. They are also responsible for the fair presentation of the financial statements on an annual basis. We have a couple snippets here from an engagement letter. And you'll notice the audit objectives, which is on page 2 of your engagement letter, says that the audit objective of our audit, the auditors, is to express opinions on whether your financial statements are fairly presented in all material respects. We will also provide a report, not an opinion, just a report, on internal controls related to the financial statements in compliance with the matters of the audit. It also goes on to say that management is responsible for establishing and maintaining effective internal controls, including evaluating, monitoring, ongoing daily activities. You are responsible, which means management, is responsible for the design and implementation of programs, controls to prevent and detect fraud, and informing any known suspected fraud affecting. Can't read. Gotta get better glasses. But the point of that is that part of recovering from fraud is making sure that your mayor and your council and your commission and the board of your entity understands what an audit does and what an audit doesn't. I know the mayor and the council of the city of Florence had no idea. They basically thought the auditor came back, gave them a clean opinion, life was good, everything's peachy, we don't have any problems. And obviously it was just the opposite. So management has to make sure they're involved in the day-to-day activities and continually monitoring the internal controls in place. The auditors will tell you they will plan to perform the audit to obtain reasonable rather than absolute assurance about whether the financial statements are free of material misstatement. And because of inherent limitations of an audit, combined with the inherent limitations of internal control, and because we will not perform a detailed examination of all transactions, there is a risk that material misstatements may exist. And the reason I point out this slide is because of this. This is a check register of the embezzlements that took place at the city from fiscal years 1999 through fiscal year 2002. You can see the amounts on there. They range anywhere from $455,000 to over $700,000. In each of those years, any one of those amounts was not material to the city's financial statements. The city was operating on a budget of $18 million plus. So even though this fraud occurred, it wasn't material to the financial statements. So remember that an audit is not designed to provide assurance on internal control. It is just there to identify any significant weaknesses, or material weaknesses that the auditors might find as they go through their tests of transactions. If you haven't received your audit report this year, and maybe you have, maybe you haven't paid attention to it, please read the new revised independent auditor's opinion. The City of Florence just received their audit opinion, audit report a couple weeks ago. The ICPA has taken another stand. You don't read your engagement letter. Now, on the face of the independent auditor's report or opinion, they're basically staking out, this is management's responsibility, this is the auditor's responsibility. So they're trying to make it as clear as they can to the organization and to the public where your responsibility is, where it stops, and where the auditor picks up. You need to understand why fraud can and will occur. Management or an employee has to have an incentive or pressure to commit a fraudulent act. The person has the ability to override controls, and the person has the ability to rationalize internally that it's okay that I'm stealing. I deserve it. I'm entitled to it. You have to realize that any software or method of internal control that you put in place can be circumvented. You can have the best system in the world, and you can think you have perfect segregation of duties and perfect internal controls, but in the end, it can't be circumvented. You have to have a certain amount of trust in the person handling the finances of your entity. And you also have to be able to count on the integrity of your employees. Budget constraints and the rationalization of the cost versus benefit philosophy will in most cases prevent a total segregation of duties. And you have to remember that no matter what controls you have in place, no matter what counting system you have, no matter what oversight you have, there is no foolproof system that is ever going to prevent a fraudulent act from occurring.
As Linda stated earlier, less than a year after sentencing, Ron Epling died in jail due to long-time medical issues, including diabetes and heart condition. A sad end to a sad story, maybe, maybe not. But it was a story of lies, a story of deceit, and a story of a double life. Our taxpayers' money was used to purchase an elaborate home for his soon-to-be ex-wife that we found out was paid for in cash. The builder never notified anybody the house was being paid for in cash. He took those and went on his way. He purchased another house for his stripper girlfriend. She got a house of much less quality than the soon-to-be ex-wife did, though. The city had funded the purchase of Great Clips hair salon franchises. So at the end of the day, we owned several Great Clips hair salons and probably should have sent all of our residents and employees to get a free haircut. What we found out from that was that if you bring the name of a franchise like that into, ill repute, they will jerk the franchise. Had they done that, had we done that, and had they pulled the franchises, they would have been worthless. So we worked out an agreement with his ex-wife widow, where she actually paid the city back the value of those franchises. We set up a payment plan until those franchises were paid for or she sold them and paid off that note. It was important that we not do anything to jeopardize our recovery effort, and that was one of them. We found out we had red season tickets, we had Bengal season tickets, and we had the ever-coveted University of Kentucky season tickets. When the state police detective came walking out of Ron's office with the 100th anniversary tickets for the University of Kentucky, he said, "Can you guess what these are worth, Mayor?" So those seats went empty that year, I'm afraid. There were coin collections, retirement accounts, as Linda said, and luckily for us, a $500,000 life insurance policy. The answers here are easy. Somebody who chooses to steal and embezzle will find a way. We have to do our due diligence. We have to set up the systems that make things more transparent, and we have to understand that the responsibility is ours. It's the government, it's the boards, it's the members. Trust is a very difficult thing to learn, and a very difficult thing to recover. It was somebody that had been at the city for 15 years. Everybody was shocked. Everybody was surprised. Very unassuming, very laid back, very much just a normal guy as far as we knew. We had no idea. And as we mentioned earlier, If nobody's willing to tell you that they think something is wrong, if nobody's willing to tell you that they're buying property with cash, if nobody's willing to tell you these things, there's no way you can investigate and find out. So once the trust is broken, it's very difficult to get it back. And I would encourage each and every one of you, have trusted employees, have people you can count on. And I guess the words are trust but verify. Be very aware that at the end of the day, it is the responsibility of the elected official, the appointed board, and the people who sit in those chairs to make sure that they're doing their due diligence as well. I'm Diane Whalen, this is Linda Chapman, and we are investment survivors.